you looking to unlock the value in your home with a second mortgage, but unsure how much you can borrow? You're not alone. With the housing market heating up, more and more people are asking the same question. Today, I'm here to simplify second mortgages for you so you don't miss out on the potential financial benefits that a well-planned second mortgage can offer. It's important to understand that there are two types of second mortgages: second charge mortgages and second home mortgages. Yeah, they do sound similar, but they serve entirely different purposes, and the amount you can borrow depends on which type you're considering. A second charge mortgage is a secured loan that uses your home's equity as collateral. This equity has been built up over time as you paid off your first mortgage. The amount you can borrow with a second charge mortgage usually caps at about 85% of your home's equity, but there are some expectations. You may use this loan for a variety of reasons, such as home improvements, debt consolidation, or even to help buy a second home. However, to be eligible for a second charge mortgage, you need to meet a few criteria. These include having sufficient home equity, UK residency, proof of affordability, and a good credit score. On the other hand, if you're considering a second mortgage to buy a second property, you'll need a substantial deposit and a low debt to income ratio. Some even use a second charge mortgage to gather the deposit for the second home. So, can you take out two mortgages on one property? Well, the short answer is yes, as long as a second mortgage can be secured with home equity. This is known as a second mortgage charge, a term which you'll come across quite often. There's a great deal of flexibility with second charge mortgages. There are no restrictions on what you can use the money for. Common uses include home improvements, consolidating debts, and even helping family members buy a home. But remember, with every financial decision, there are pros and cons, and a second charge mortgage is no exception. The benefits include the potential to access large credit amounts and potentially lower interest rates. However, the risks include the possibility of losing your home if you can't repay and additional mortgage fees. The amount you can borrow will largely depend on your debt to income ratio, the amount of equity in your home, and your credit score. Typically, second charge mortgage providers cap the amount that you can borrow against your equity at 80 to 85%. For instance, if you have 150 grand in home equity, an 80% loan to value ratio would allow you to borrow up to 120 grand. However, this will depend on your credit score and other financial factors. It's important to remember that there are alternatives to a second charge mortgage. These include home equity loans, home equity lines of credit, which are called HELOC for short, personal loans, credit cards, home improvement loans, and debt consolidation loans. If you're considering buying a second home, remember that you're likely to need a sizable deposit. Most lenders want a down payment of at least 20% of the second home's value in cash. Also, your debt to income ratio needs to be under control. Speaking of second mortgages, it's important to know what they are. They're essentially secured loans that use your home equity as collateral. You can use this loan for a variety of reasons, from home improvements to debt consolidation. The prerequisites, well, you'll need a sufficient amount of home equity, UK residency, proof of affordability, and a decent credit score. There are also other alternatives you could consider, such as home equity loans, HELOC, personal loans, credit cards, home improvement loans, and debt consolidation loans. Buying a second home requires a substantial deposit and a low debt to income ratio. Some even use a second charge mortgage for the deposit. Now let's take a deep dive into both of these scenarios. First, if you're thinking about a second charge mortgage, the principle is pretty simple. As you pay off your existing mortgage over time, your home equity grows. This equity can be used to secure a second mortgage if needed. But remember, this second mortgage, or second charge mortgage as it's officially known, is a secured loan that uses your built-up home equity as collateral. So, if you fail to keep up with repayments, the lender has the power to repossess your property and sell it to recover the debt. The two main reasons people opt for a second mortgage, well, home improvements and debt consolidation. Other uses could also include helping to buy a second home or holiday home, aiding family members in buying a home, paying for private education or medical bills, or even purchasing luxury items like an expensive fancy car or holidays. Like anything, there are pros and cons to a second charge mortgage. On the positive side, you have the potential to access large credit amounts and potentially lower interest rates. It also allows you to avoid early repayment charges when remortgaging. But on the downside, it's heavily dependent on your home equity and you risk losing your home if you can't repay. Plus, there may be additional mortgage fees to consider. Eligibility for a second charge mortgage requires proof of your ability to afford the monthly repayments. This means that you've got to reveal your personal finance details such as income and existing debts. Your credit score will also be evaluated to see how well you manage your debt repayments. So how do you know if you can afford a second mortgage? Well, it all boils down to your debt to income ratio. The mortgage provider will run a few affordability checks comparing your income against your essential debt expenses. Your total debt should ideally be less than 40% of your income, with some lenders even considering this percentage to be too high. Now let's talk numbers. Second charge mortgage providers typically cap the amount of equity you can borrow against 80 to 85%. So for example, if you have 150 grand home equity, a second charge mortgage with an 80% LTV would allow you to borrow a maximum of 120 grand. But what if you're looking to buy a second home? Well, in this case, you'll need a significant deposit, often 20% or more of the home's value. Your debt to income ratio will be assessed, taking into account your current mortgage and any other debts you may have. As a general rule, your total debt should be around 40% of your income or lower, including interest payments. Some people use a second charge mortgage to help fund a second home purchase. But remember, this mortgage will also be considered as a debt relative to your income. And if your debt to income ratio is too high, you could be denied a mortgage to buy the second home. One tool that can help you calculate your potential second mortgage is a second home mortgage calculator. These calculators are designed to help you figure out how much you can afford to borrow and are increasingly being offered by financial institutions online. When using a second home mortgage calculator, you input your monthly income, current monthly debt payments, the loan term, interest rate, and down payment. The calculator then estimates a maximum mortgage amount that you could afford for a second home. It's important to note that these calculators should be used as a guideline and not a definitive answer to what you can afford. Other factors such as your credit score, the state of the housing market, and the specific criteria of the mortgage lender will also play a role in determining how much you can borrow. When purchasing a second home, you also need to consider the additional costs involved. Beyond the mortgage payments, you'll have to pay for property taxes, insurance, and maintenance costs. Now, these costs can add up, so it's important to factor them into your calculations when deciding if you can afford a second home. As for the types of mortgages available for a second home, you've got several options. You could go for a traditional fixed rate mortgage where the interest rate stays the same throughout the loan term, or an adjustable rate mortgage, that's an ARM. Or ARM, whatever you want to call it, where the interest rate varies over time. Alternatively, you could opt for an interest-only mortgage, where you pay the interest on the loan for a certain period and then start paying off the principal. Whether you're considering a second charge mortgage or buying a second home, it's crucial to understand your financial situation, your ability to afford the repayments, and the potential risks involved. It's also a good idea to speak with a financial advisor or mortgage broker to help guide you through the process and ensure that you make the best personal decision for your personal circumstances. They can also help you understand the various options available to you and how each one might impact your financial future. If you're interested in finding a loan for your circumstances, simply click the link below and fill out the short form. It contains a few questions like whether you're a homeowner and how much you'd like to borrow, and then it'll give you access to quotes from around the UK tailored to your circumstances. It's totally free to do, and of course it won't affect your credit score, so click that link below, fill out the short form and give it a try.